All right, let's get started. Well, again, welcome to the Bond vs. IUL webinar hosted by BackNine Insurance. My name is Zach Engel, and I'll be your presenter this morning. So let's go ahead and jump right in. Today we're going to talk about the conservative portion of a client's portfolio and how an IUL, a max-funded IUL strategy fits in there nicely and can compete and even outperform a bond allocation. So one of the most important aspects of this is making sure we frame the story right for our clients. We want to change the perception of life insurance as an asset class. So one of the ways I like to do that, and I see some of my advisors having success, is to go ahead and start the conversation as they're just talking about a different allocation strategy or a different asset class. Don't bring up life insurance until it's absolutely imperative. So now let's be a little simplistic. And let's say there's two phases of retirement planning. You've got your accumulation phase and your distribution phase. The overall tone for the retirement planning strategy is, you're going to reach a point in the planning process where you're going to need your portfolio to be a little bit more conservative. You're going to start scaling back off your riskier investments, and you're going to prepare for longevity, and you want that longevity both in terms of your accumulated wealth, but also life expectancy is increasing. So we want to make sure that a client's portfolio lasts and can maintain the lifestyle that your client is accustomed to over those years. So when we're talking about the conservative portion of a portfolio, there's generally three goals clients tend to have. We're going to have low risk. They're reaching that retirement age. They don't want the volatility in the markets to affect their portfolio. They need to make sure that their money's safe. They're going to also expect small to moderate growth. We don't want to just stuff it in a mattress or in a low-earning CD. We need to still make sure our money's working for us, but in a safe, moderate, low-risk environment. And then again, it's long-term safety. So when we're talking about a conservative portfolio, we're talking, cash, CDs, bonds, and bonds are the most common form of a conservative investment. So in relation to those goals, what we find is most important to our clients is safe, conservative, reliable growth with little to no risk. And of course, every one of our clients is looking to pay fewer taxes. Let's look at let's take a look at an asset here. If I was talking to a client, or you were talking to one of your clients, and you said you could offer an asset with a floor of 0 to 1%, so there's no downside risk whatsoever. You could also offer them historical average annual returns of 8.53% given a 20-year time horizon. Now that's important. Bond portfolios are generally looked at as long-term investments. So we're going to look at this asset as a long-term investment. We're going to try to shoot for a 20-year time horizon. We're also going to be able to offer tax-free income distribution and the added ability to protect against long-term care. If you outlined an asset vehicle like this for a client and asked them how much of their accumulated wealth they'd want to allocate to this, very few of our clients would argue or, they'd say everything I own. So that's a great way to start and frame that conversation when we're talking to our clients. So let's go into a case study. We've got a 55-year-old male. He's got a great family, a great job. He's been able to accumulate a good amount of wealth, and he's planned well for retirement. He's been maxing out his qualified accounts. He's been setting savings aside, and he's got, different allocations between equities and different sorts of investments. But he's approaching retirement age, and he wants to make sure his wealth lasts long into retirement, and he wants to make sure that he's being a little smarter about his money. He's moving those riskier investments into a more conservative allocation. So he goes to his financial advisor, and his financial advisor recommends one of two options. You're going to place a portion of your riskier investments into a bond portfolio, or we're going to start max funding an index universal life policy. And like I said, most of our clients aren't used to hearing life insurance talked about as an asset class. So again, that's where I like to frame this conversation and bring that up last. You want to make sure you're talking about the features involved in the life insurance policy and contracts that are attractive, the guarantees. So now let's compare bonds to IULs in terms of returns. If we look at the bond market, some of the most popular bond allocations out there today is the Vanguard bond allocation, the Barclays aggregate U.S. bond, and of course the 10-year U.S. Treasury bond just as kind of a staple in the low end. That's a little bit closer to a short-term investment than a long-term, but it gives you a good picture. So the Vanguard and Barclays, two of the most popular bond allocations out there, the average annual return is just about 5%. It's really a struggle to get your bond portfolio to perform any higher than 5% when we're talking over a 15, 20, 25-year time horizon. Now in comparison, we have the index universal life with the S&P 500 allocations. So the standard point-to-point with 100% participation and a 12.5% cap over a 20-year time horizon offers you that 8.53%. As you can see, with a different annual point-to-point allocation strategy there, you can get up to 7.29%, and these are just averages. And there's also the blended account. So one thing to keep in mind when we're talking about these index universal life products is there's multiple allocation strategies within the S&P 500. You can have annual point-to-point. You can have a blended account, which is, that includes some bond allocations as well as, higher risk hedge fund allocations to kind of blend it out for you and help you deal with the market volatility. So there's multiple options. You've got monthly point-to-point. It's really a matter of your client's preferences as well as the carrier we've chosen, again, which comes down to your client's wishes when it comes to the different riders and allocation strategies available. So that's where we're here to help you build that case and decide which of those allocation strategies is right for your client. So let's do a comparison here. Bear with me and kind of ignore that middle column there for a second. Let's talk about the long-term bond. A 55-year-old takes $500,000 out of their portfolio and allocates it to a bond. You're going to let that grow for 20 years. Here I've chosen 4.62%, which is that annual average return from the U.S. Barclays aggregate bond allocation. So if you go ahead and throw that $500,000 in there, you let it grow for 20 years. At age 75, you're going to have $1.2 million approximately in that bond. After you take into account the long-term capital gains tax, your after-tax net distribution is just over $600,000. Now, if we're talking about an IUL strategy here, we're going to talk about the same $500,000, the same 20-year time horizon, but I've chosen a conservative or relatively conservative internal rate of return. Now, like I said in the prior slide, with an annual point-to-point allocation and a 20-year time horizon, you can expect an 8.5% return. So I scaled it back a little bit to 7%, just to take into account the markets and be a little conservative for our client here. So at age 75, you have $2.2 million. But what's super important, and the kicker, is the fact that there's 0% tax on these distributions. So the after-tax net distribution is $1.7 million. So a full $1 million more is going to be available to your client. That's just a no-brainer right there. And if you take into account the fact that there's going to be a tax-free death benefit also associated with this policy, whereas there's nothing in the bond markets that resemble any kind of a death benefit. So you can see how those two compare. Now that middle column there, I chose to show you what a bond would need to perform at just to kind of match those distributions of the IUL. And you're going to need to find a bond allocation out there that's returning about 8% annually. And as we saw from the prior slide, that's just unrealistic. You're not going to find a bond allocation out there that's performing that well. So it seems like a no-brainer when you look at it from, just straight across looking at the numbers. So let's go over those benefits one more time. You have no risk. You have the 0 to 1% floor depending on the carrier. You have the potential for high upside growth, which you just are missing in the bond markets. You have tax-free income distribution. Again, you don't have to pay any form of taxes, let alone long-term capital gains tax like you do in the bond market. And then you have a tax-free death benefit. Depending on the state you're in, there's long-term care protection available that can be added onto these as an additional benefit to help your client through those retirement years and handle those long-term care health expenses. There's other riders available out there. Again, it just totally depends on your client and what their needs and wants are for this contract, but we're here to help you. So real fast, let's talk about an ideal client. You're going to want them to be, 30 to 60 years old. They can be in their 20s. I actually just did a case for an advisor on a 26-year-old who was doing well financially, and he wanted to make sure and set a great baseline and protect the conservative portion of his portfolio from early in life and give him the freedom to invest a little more aggressively as the years went on, knowing that he had his baseline set. So it doesn't have to start at 30, it can be in the 20s. But what's most key here is not only relatively healthy, we are talking insurance, but you need them to be high income earners. You want them to be clients who have maxed out their qualified plan. They need to be planning for retirement and have adequately covered their qualified accounts as well as setting aside money for maybe some more risky investments to kind of, keep their money working for them. So high income earners, relatively healthy, and that have a 15 to 20 year time horizon. Really, the first 10 years, due to the cost of insurance, you're not going to see the returns that make this a viable option. This is a long-term investment. We're looking and talking to clients, and it's going to be 15 to 20 year time horizon, and the longer the better. So let us help you. We're here to do your case design, talk to your clients, find out what's important to them, and then come back to me and I'll talk you through which carriers have the best, the best riders and different options available for your client, as well as the allocation strategies that best fit your client's needs. So following this webinar, you're going to receive a case study similar to what we ran through today, marketing piece, again, in companion with that case study, companion illustrations, and the webinar recording. So lastly, before I let you go here today, we're going to show you a quick little video about our BOSS system. That's our back office support system. It's our complimentary system that we offer to all of our advisors. It helps them track their production and their cases, their commissions, and chat with their case manager. It's a fantastic feature, again, complimentary to everybody. So bear with me real fast and I'll throw that video on.
With all the time it takes managing cases and clients, it can be difficult to stay focused. What's going on with my case? When do I get paid? Is the product a perfect fit? Luckily, selling insurance became easier. BackNine Insurance, a boutique brokerage general agency, has the mission to simplify the selling of insurance. We have built an insurance-focused CRM with independent producers and hierarchies in mind, called Back Office Support Systems, or BOSS. With BOSS, you have your entire practice at your fingertips, with the ability to manage clients, track all your cases, view your production, and set goals. Each case has a full report where you can find all the details, including premium, benefit, underwriting class, beneficiaries, policy values, and download your documents. Know exactly where you stand on each case with requirements and status updates, and quickly correspond with your case manager via chat. View your commissions and see how it's broken down by line and individual product. Use it at the office, your appointment, or anywhere you go, so you have the confidence that comes with being sure of your business, and you can spend time focusing on what matters most. Simplify your life with BackNine's back office support system, and get started today. With all the time it takes managing cases and
Well, thanks for joining us today. I appreciate you bearing with me. It was just a short presentation this morning, but I think it's important and something always to keep in mind. My contact info is right there. Zach Engel, I'm a brokerage director here. I'll help you with that case design. Shoot me some case info. Let's talk about making some money. Hope you had a great day. Thanks for listening, and enjoy the rest of your day.